Hey, Jason, you have a 145 price target. How much more do you like it now?
Well, let me frame it for you. We are probably the last sell-sider that's still doing some of the parts on Disney. What the buy side has done is essentially given up on DTC. If you're generating losses, they're not going to put a multiple on that. I think that's crazy. If you put the same revenue multiple that Netflix gets, it's worth $45 a share, and that's essentially the spread between the $100 that it trades at today and what we're saying it's worth. There's nothing about Disney's streaming business that won't be as valuable as Netflix. The problem is for Disney and a lot of other companies, the street is just unwilling to accept losses in this current regime. That's fine, but I just think that the logical implication of that is to say Disney's streaming business, which does over 20 billion of revenue, is worth nothing, is a bit extreme to me.
Okay, so we got Iger in. He's got to get the street to take a different view of that. How does he go about it? Is it just about dealing with the losses? Is it that straightforward, or is there something else, other levers that he can pull, consolidation, etc., that can make this happen?
Well, let me roll the clock back a bit. I think the template that Mr. Iger had was he was going to complete the Fox acquisition. He was going to get the DTC business launched, and then pass the baton to Mr. Chapek, who is going to execute on the plan. And I don't think that there's a chorus of institutional investors that were looking for this change. That's why it surprised everybody. So I think there's sort of two implications about why this happened internally. One is the targets that they laid out for 2024 in terms of subs and getting to break even at the DTC business is not going to happen. And they don't want someone that doesn't have a lot of love to communicate that message to the street. So if you're going to communicate that bad news, you'd rather it come out of someone like Mr. Iger than Mr. Chapek. That's one path. The second is that you may hit those targets, but to really get the profitability, you're going to have to pursue M&A. And there again, if you're going to try and convince institutional investors that we need to buy another studio to get more synergies, to get this at the proper scale, you want someone of Mr. Iger's stature to communicate that. So those are the two, I think, most likely paths.
I should point out that Disney off the highs here as markets in general are rolling over. Jason, I'm curious, though, as to the streaming part, because isn't the whole point that the street doesn't want Disney spending this much and losing this much on its streaming network? But Bob Iger is firmly behind the streaming network. So how do these two things reconcile?
Well, when you say these two things, you mean, say it for me one more time.
Just that Bob Iger is obviously a firm supporter of Disney Plus, but Disney Plus is a thing that the street's mad about.
Well, I don't think they're mad about the strategy. They're just don't like the losses, right? And so if you think about that, you have to paint a credible picture for how we're going to go from the 4 billion of EBIT losses they generated this last fiscal year to break even. And that's what needs to be articulated. Now, maybe that can't be done organically. Maybe it requires M&A. Maybe it can be done organically. It's require cost cuts. But that's what needs to be communicated to the street.
Okay, let's talk. Okay, so they're going to change the rules. They're going to change the metrics, which Chapek clearly didn't do and wasn't capable of delivering. By how much do the metrics change and in what way? So Iger's going to rewrite the rules of the road there. And on the second bit, to get this thing to profitability, as you say, it's either cost cuts or M&A. Iger's probably an M&A guy. How big does he go? Like, is Netflix within the purview of potential M&A here? How big could he go in order to fix the problem?
Well, I don't. Netflix would surprise me, something that large. I mean, I think about cost cutting across studios, traditional studios, and think about building or acquiring a big library of content that's actually owned. So there's a number of other media companies that are out there that are subscale, that have deep libraries where you'd get a lot of cost saves. And so that's where I would be thinking. I mean, I think everybody knows that there's too many DTC products out there, and there are a lot of companies that don't have sufficient scale to cross the Rubicon and generate profits. And so rationalization, I think, is the order of the day, not among the what I'll call the two winners, Disney, Netflix, but more from the players that aren't going to get there.
Jason, how long do you think the street's going to give Bob Iger to show or say something that's going to make him feel better?
Well, let's see. I think Mr. Iger is going to move pretty quickly. I mean, he's not a patient executive, right? If he sees problems, he takes action, and it's pretty fast action. So I think we'll get something we'll get some communication from the street about what the plan is. I would think, early 23. And I would suspect, if there is any sort of M&A, that will certainly be announced before this 2-year window that Mr. Iger has.